Hello, and welcome to our detailed analysis of the Buffett indicator. Today, we will explain in detail what the Buffett indicator is, how it is calculated, how to interpret it, and what historical examples show how effective it can be. At the end of the video, we'll also address the criticisms and limitations of this indicator. So sit back and let's dive in. Stay tuned, as right after the intro, we'll jump straight into it. Before we start with the video, please note that this is not investment advice, but rather my personal research. What is the Buffett indicator? The Buffett indicator, named after the legendary investor Warren Buffett, is a measure often used to assess the valuation of stock markets. Buffett himself described this indicator as probably the best single metric to assess the state of a stock market. But what exactly is the Buffett indicator, and how does it work? Definition and meaning. The Buffett indicator measures the ratio of the total market capitalization of all listed companies in a country to the gross domestic product, GDP, of that country. The idea behind this ratio is simple. If the market capitalization is very high compared to GDP, the stock market could be overvalued. On the other hand, if it is low, the market could be undervalued. Calculation of the Buffett indicator. Buffett indicator equals total market capitalization divided by gross domestic product, GDP. To illustrate this, let's use actual numbers. Suppose the total market capitalization of all listed companies in the U.S. is $54,588 billion, and the gross domestic product, GDP, of the U.S. is $28,629 billion. The calculation would look like this. $54.588 billion divided by $28.629 billion equals 1.96 or 196%. This means that the total market capitalization is 196% of the gross domestic product interpretation of the Buffett indicator. The Buffett indicator helps us understand whether a stock market may be overvalued or undervalued. Here's how to interpret the results. Undervalued. A value below 100% could indicate that the stock market is undervalued relative to the economy. Investors might view this as a buying opportunity because the market may have room to grow in line with the economy. Fairly valued. A value around 100% is often considered fairly valued, meaning the market capitalization is proportionate to the economic performance of the country. Overvalued. A value significantly above 100% could suggest that the stock market is overvalued in relation to the economy. This could serve as a warning signal for investors to proceed with caution, as it indicates potential market corrections or downturns. Historical examples of overvaluations and undervaluations. To understand the usefulness of the Buffett indicator, let's take a look at some historical examples. Bubble of 2000. At the start of the new millennium, the stock market experienced an immense upward movement, particularly in the technology sector. The Buffett indicator rose to over 150%, indicating a massive overvaluation. Many technology companies had huge valuations driven by speculative expectations of future growth, although they often generated little or no earnings. In 2000, the dot-com bubble burst, leading to significant losses on stock markets worldwide. Financial crisis of 2008. Before the 2008 financial crisis, the Buffett indicator was also at a high level, exceeding the 100% mark, which indicated overvaluation. The real estate market in the U.S. was heavily overvalued, which ultimately led to a major financial crisis. After the markets collapsed, the Buffett indicator fell as market capitalization plummeted and the economy entered a recession. COVID-19 pandemic of 2020. The COVID-19 pandemic brought enormous economic uncertainty and a temporary slump in stock markets. Despite these uncertainties and the economic downturn, the Buffett indicator rose to over 200%, again raising concerns about possible overvaluation. However, the markets recovered faster than expected, supported by massive fiscal and monetary policy measures worldwide. This shows that while the Buffett indicator is useful, it should always be viewed in the context of the current economic and political situation. Criticism of the Buffett indicator. Although the Buffett indicator can be a valuable tool for market analysis, there are also points of criticism that should be taken into account. 1. Globalization of companies. Many large companies generate a significant portion of their revenues outside their home country. This can distort the market capitalization relative to GDP, as GDP only measures the domestic economy, whereas companies may operate globally. For example, a company based in the US might earn substantial revenue from markets outside the US, inflating its market capitalization compared to the country's GDP. 2. Differences in capital structure. The Buffett indicator does not take into account the capital structure of companies. Companies can be financed differently, with more or less debt, which affects market capitalization. Firms with higher debt may have larger market capitalizations, even if their actual economic output remains lower, potentially leading to misleading conclusions. 3. Interest rate. Environment. Low interest rates can drive up stock market valuations as investors search for yield. In such a low interest rate environment, stocks become more attractive relative to bonds or other fixed income investments. However, the Buffett indicator does not directly account for the current interest rate environment, which can limit its usefulness during periods of low interest rates. 4. Growth rates. Countries with different economic growth rates may have different Buffett indicator scores, which do not necessarily indicate overvaluation or undervaluation. For example, a rapidly growing emerging market may have a higher Buffett indicator, but this could be reflective of strong economic growth rather than a stock market bubble. Additional criticism. Technological disruption. Another potential limitation of the Buffett indicator is its inability to fully account for technological disruption. Companies in the technology sector often grow faster than traditional companies and may drive market capitalization to higher levels. However, this growth could be due to genuine innovation rather than overvaluation. As tech companies dominate the market, the Buffett indicator might give false alarms of overvaluation, even when it reflects the real value of future growth driven by technology. The role of government policies. One more factor that can influence the effectiveness of the Buffett indicator is government intervention. For instance, in times of crisis, governments may implement large-scale stimulus packages or monetary easing, which can inflate market capitalization without a proportional rise in GDP. In such cases, the Buffett indicator may signal overvaluation, but this could be misleading if the economy is being propped up by temporary government actions rather than true market conditions. Therefore, it is important to consider these external influences when using the Buffett indicator. To summarize, the Buffett indicator can be a valuable tool for evaluating stock markets in relation to the economy. It provides a quick overview of market valuation and can help investors identify potential overvaluations or undervaluations. However, it is important to consider this indicator in the context of other economic factors, such as interest rates, globalization, and capital structures. While the Buffett indicator has been effective in identifying market bubbles in the past, as seen during the dot-com bubble and the 2008 financial crisis, it should not be relied upon in isolation. Investors must also consider other financial metrics, global economic trends, and current political conditions to form a complete view of the market. Thank you for watching. If you enjoyed this video, please give us a thumbs up and subscribe to our channel for more in-depth financial analysis and market assessments. Share your thoughts and questions in the comments below. We'd love to hear what you think.